Well, let's say you've made a good decision, right? You've used your indicators, you made a good buy decision, you've bought a security, right? And now how do we maximize the profit out of that, buy that we just made? We want to make profit on this. How do we maximize that? And that's a key part of managing your overall trades and your trade rules and all that, along with reducing losses, is looking at targets of when we want to sell. Because it kind of answers that whole age-old question, when do we cash in? How do we know enough is enough that we need to sell and book our profits and then move on to another security, or wait for another opportunity, maybe with that same security, to buy in again, right? But at some point, doesn't go up forever. At some point you're going to sell and then maybe later get back in if conditions change. But when you do that, when do you cash in? I mean, sometimes you can go by feel. It's cloudy out today, so I think I'm going to sell a lot of stocks. I mean, or I just feel like it. That doesn't sound very technical analysis like, right? Or sounds very emotional, actually. So that's not necessarily the best way. There's actually better ways that you can do this, and we're going to talk about that in this lesson. Several ways that you can build some trading rules around when to maximize your profit and really how to set up price targets. That's the idea of this lesson, is when to cash in and book those profits. Now, one of the common ways that you can do it is you rely on your indicators, right? You relied on your indicators to buy into a security. Rely on your indicators to sell out of that security, right? So if they tell you when to buy, they'll also give you sell signals, as we learned in all these different indicators and tools we learn about. And the benefit of using indicators is that it gives you the ability to maximize gains, right? You're using your indicator to tell you, what is the right decision making. Now, the challenge with that, of course, is sometimes indicators are not foolproof. They can give false signals. So you might sell before you really should have, or maybe you think you should hold a little bit more, but really you should have sold right away, right? So nothing's perfect in that, but using your indicator will help more maximize gains, more so than maybe some other ideas that we're going to learn about. It also requires a challenge, and it requires more market monitoring time, right? Because you've got to be a little bit more watching and watching for these sell signals to happen. So you're going to have to watch your securities a little closer that you have an investment in. Now, we're going to learn about things like setting up stop loss orders and things to help automate that. So don't worry about that. But even still, you want to start monitoring that a little bit more. But there are other ways you can do it besides relying on indicators. For example, you could establish a profit percentage target, right? And you could say, okay, I bought into something and my target is a 10% return or profit on a trade. So if I bought at, let's say, 40 units, $40, my profit target is $4. What's my total profit I want to make? So I would sell at $44, right? So I say, okay, I bought in at this, I want to make 10%, this is when I'm going to sell it. So that's simple, right? That's the benefit of it. It's simple to execute, and it enforces discipline. Did I hit my 10% or did I not hit my 10%? Once I hit my 10%, I'm selling. I'm not waiting till 12 or 13 or 14%, I'm waiting for 10%. Now, it could be 2%, it could be 1%, it depends on how active a trader you want to be. But in this example, you get the idea that I'm selling once I reach that percentage of profit target. Now, the challenge of that is you could miss out on extra profit if the security keeps rising. Well, let's say you're on a strong uptrend and you've made your 10%, but let's say this thing kept going and you're going to make 12, 13, 14, 15, 20. You missed out on all that because you sold right away because you're good and disciplined and you had set a profit percentage target too. The other thing too you want to be aware of is, let's say you don't ever get to the profit percentage and never gets up to 10%. Then are you kind of stuck in a little bit of a sideways move and it's just kind of stuck there? Or is it now starting to reverse and go downward, but you haven't reached your 10% yet? How do you get out from that? So those are some things to consider if you're establishing a profit as a percentage target. So one way to counteract that is to set a percentage of the range target. So you could look at and figure out the average high to low range, high price to low price range, over a certain number of trading periods. It could be days, minutes, hours, whatever your trading range is. And then you use indicators, assuming you're trying to buy in or you're at or near the low end of the range, right? That's the whole idea of using an indicator. You're probably not buying at the high end of the range. Sometimes you can with momentum and all that. But let's say your style is you're buying more towards the low, and your idea is that it should rise towards the middle or towards the upper part of this natural range. Especially your indicators are telling you it's a buy signal. So you determine the percentage of the range you want to capture the profit of. Let's say 50% of the range, could be any number, since you're buying at the low end, there should be more upside, right? So 50% seems pretty aggressive, but you're buying in and you're exiting at the end of the range, not 50% profit. You're looking at the range there. So this will make a little more sense if we look at it as an example right here. So let's look at a percentage of the range target, a target sell time based on this example. So let's say you're over 20 periods, the high for something is 150 and the low is 130, right? So that's the high and low over 20 periods. So the range is 20, right? 150 minus 130, the difference between the high and low. And then the 50% of that range, simple to calculate, what's half of 20, basically would be 10, right? So you figure out that's your target. So if your target's at 50%. So you would sell at 140, right? So I'm buying in maybe near the bottom of the range. Maybe I'm at 130, but maybe I'm buying in at 135 because I'm not at the absolute low of the range, but I know my range is this. So once I get to 140, then I know I've reached my profit. If I bought at the absolute low, like in this example in the fourth bullet point, I'd be 130 plus $10 would be 140 I'm selling at, and I would have made $10 of profit. But if I bought at 135, I made $5 of profit. The benefit of this is you have a clear sell target, right? You have an actual real number that you're going to look at. That once it hits that real number, you're selling, right? So you've built in that profit. And 50% is just an example. That's for many, you might want to look at 10% of the range or 25% of the range. How wide the range can impact that too. A wider range is going to have a higher, absolute number target than a smaller range. So in this case, the example, the range was 20. What if the range was 80, right? Now you have a wider range, and that can make a difference. So the benefit is you do have that clear sell target. You don't have to think much. It's like, once I hit that number, I'm selling. The challenge is the range can widen during that whole period. You aim to be on the low end of the range, but maybe that range has now started a period where it's now widening out or possibly narrowing out too, and that changes your basic number. If it starts getting, if you aim too low, that might be a little bit higher number to reach that you might not ever get to. And if it's too narrow of a range, your target might be too ambitious, or in some cases less ambitious, actually is another way to look at it too. Either way, your range can change over time too. So the more established the range, the better this percentage of the range works. Also, there's, it's very common to have temporary pullbacks. And that might mean a stop loss that does not cause a stop loss to occur. Then it can make your range goal harder to hit. So let's say we bought at 135 in this example. We're looking to get 140, but all of a sudden we get up to 132 and there's a pullback back down to 128. Now I've got further to go to get to my 140, so I might end up holding the security longer or may never get there to really realize my true profit on it. So there's, it's a nice clear sell target, but there's also some challenges to it as well. Another way you can use is look at measured move patterns. And this is kind of related to indicators, depending on the indicator you're using, but some indicator patterns have built-in forecasting, like ascending triangle or support resistance lines, like we see an example here. And so when you buy in, you're setting your price based on the pattern continuation. So if I was looking at that support line, let's say I'm buying near the bottom, I want to buy near the bottom, near the support line, I know that it's going to rise up hopefully to this resistance line and follow the pattern. And as I get up to that resistance line, okay, now I'm going to sell again, right? So that's my target, is if I get closer, I'm picking a real number, a whole number, or a number, an amount that's close to that actual resistance line. And once I hit that number that's near the resistance line, I'm going to sell. I'm going to watch the pattern continue, and if it doesn't break through that resistance line, it's going to come back down. And if it bounces back up off that support line, I'm buying in again. And then I do the same thing again where I'm waiting for the pattern to continue, and I'm going to go up to that resistance line. Again, I would get out of this completely, or maybe look at something different if it broke through either the resistance or the support line. That showed that the trend here, which is a pattern continuation trend in a narrow channel, basically, I would change from that. But I'm setting my pricing, my buy and sell based on following the trend. So the benefit of this is it's indicator driven, which is a good thing, right? It's driven when we buy and it's driven when we sell. So it's indicator driven. The challenge of that is you're limited to your trades to those patterns, right? So you might have different, less opportunities for trading because you're looking for that perfect kind of pattern or certain situation to occur. When they do, they can be very rewarding. And if you're not as frequent a trader and you're really looking for more of a perfect situation or a better situation to be more confident in your trades, trading over a measured move or over a measured move pattern can be the answer for you. But if you would like to make more trades and more profits, maybe less profit per trade, but do a lot of them, then this might be, be limited to those patterns and see less opportunity. So everything has its strengths and weaknesses. So these are some examples of ways that you can set up a rule or ideas behind when to sell or when to get out too as well. So not only is it important as far as when you buy in and use your indicators when to get in, it's also important when to get out. And you can use indicators to help you with that, or you can use some of these different profit measures we used in order to bank and book your profits, and then keep doing it again and again to keep having more and more profits. That's the name of the game, right?